There is something that does not get talked about enough. The person who graduated top of their class is not usually the wealthiest person at the reunion. If raw intelligence were the only thing that mattered in wealth building, Wall Street would be populated entirely by PhD mathematicians driving Lamborghinis. But that is not what we see. Instead, we see PhD mathematicians who understand derivatives pricing theory perfectly and still blow up their accounts. We see Ivy League graduates drowning in six-figure student debt while working jobs they hate. Meanwhile, a guy from Omaha, Nebraska, who skipped Harvard, who sits at a plain wooden desk reading printed annual reports, has quietly compounded $10,000 invested in 1965 into roughly $27 million today. That guy is Warren Buffett, and his track record is the most statistically significant argument against the idea that intelligence is the primary driver of wealth. Berkshire Hathaway has delivered a compounded annual return of approximately 19.8% from 1965 through 2023, compared to the S&P 500's 10.2% over the same period, not for 1 year, not for a decade, for nearly 60 years straight. So what is actually going on? Today, I want to break down the 5 operating principles that Buffett has applied his entire career, not as vague motivational advice, but as real executable frameworks backed by actual data. These are the rules that separate the people who compound wealth from the people who just look like they should. Rule 1. The 20-slot punch card. Let me give you a number that will reframe how you think about decisions. According to research published in the journal Psychological Science, the average professional makes approximately 35,000 decisions per day. Most of those are trivial, but the problem is that your brain does not know the difference between a trivial decision and a consequential one. It spends cognitive energy on all of them equally. Buffett talks about a thought experiment he shares with business students. Imagine you're handed a punch card with only 20 slots. Every major investment or career decision costs you 1 punch. When the card is full, you're done. No more big moves for the rest of your life. 20 decisions, that's it. If that were actually true, how differently would you behave? You wouldn't pile into a trending stock because someone in a Facebook group was excited about it. You wouldn't start a third side hustle before the first one was profitable. You wouldn't chase every opportunity that crossed your path simply because it was technically available to you. Here's what the data actually shows about Berkshire Hathaway. Buffett and Munger made roughly 400 to 500 investments over 5 decades. But when analysts study their portfolio concentration, the top 5 holdings have historically accounted for around 65 to 75% of the total portfolio value. That means the vast majority of their wealth came from a handful of decisions, not thousands of brilliant ones. Apple alone, which Buffett began buying in 2016 at prices well under $30 per share, grew to represent over 40% of Berkshire's entire equity portfolio by 2023, a position now worth over $150 billion. That was one call, one punch on the card. The psychological trap most people fall into is not that they make terrible decisions, it's that they make too many mediocre ones. The project that makes a little money, the side hustle that's kind of interesting, the investment that could work out. These aren't bad enough to obviously reject, but they're not great enough to truly change your trajectory. They just drain your time, energy, and capital, and leave nothing in reserve when the genuinely great opportunity finally appears. Your assignment: write down the 25 things you most want to accomplish. Circle the top 5. The other 20 are not your backup plan. They're your elimination list. Treat them as distractions until the top 5 are done. Rule 2. Defeating Mr. Market. In 2020, the S&P 500 experienced one of the fastest market crashes in recorded history. Between February 19th and March 23rd, the index fell 34% in just 33 days. Unemployment claims spiked to 6.6 million in a single week, the highest ever recorded at that point. Every major financial news outlet was running apocalyptic headlines. What did most retail investors do? They sold. According to data from Vanguard, investors pulled a net $326 billion out of equity funds during March 2020 alone. They locked in their losses right at the bottom. What did Buffett say to do? He had said it for decades. Be fearful when others are greedy, and greedy when others are fearful. That sounds simple enough to print on a motivational poster, but executing it is another thing entirely. When the market crashed in March 2020, the physical sensation of watching your portfolio drop 30% in a month is closer to a medical event than a financial one. Your cortisol spikes. Your amygdala, the brain's threat detection system, lights up the same way it would if a predator was chasing you. This is the core of what Buffett learned from his mentor, Benjamin Graham, who described the stock market through the character of Mr. Market, a fictional business partner who shows up every day offering to buy your shares or sell you his at whatever price his mood dictates. Some days he's euphoric and offers ridiculous premiums. Other days he's suicidal and practically gives shares away. The lesson is not that Mr. Market is a fool. The lesson is that his emotional swings are irrelevant to the actual underlying value of the business. A company that generates $500 million in free cash flow per year does not suddenly become less valuable because panicked traders are selling its stock. The business is the same. The price is just different. This is exactly why Buffett and Munger operated out of Omaha rather than New York. They didn't want to be surrounded by the ambient noise of Wall Street traders reacting to daily price movements. They wanted quiet so they could focus on what the business was actually worth, entirely disconnected from the crowd's current mood. The practical application. The next time markets drop significantly, your job is not to react, it's to calculate. Does the business still generate real cash? Has the long-term competitive position changed? If the answer is no and no, then a lower price is not bad news. It's a sale. Rule 3. The margin of safety. Let me give you the most brutal math in investing. If your portfolio drops 50%, you need a 100% gain just to break even. If it drops 90%, you need a 900% return to get back to where you started. These are not opinions, they're arithmetic facts, and they explain why avoiding catastrophic losses is mathematically more important than chasing extraordinary gains. In 1998, a hedge fund called Long-Term Common Management was staffed with some of the most intellectually formidable people ever assembled in finance. Their leadership included 2 Nobel Prize winners in economics, Myron Scholes and Robert Merton. Their mathematical models for pricing derivatives were by any measure brilliant. They had a track record of 40% annual returns, but they were using borrowed money, leverage, at a ratio of roughly 25 to 1, meaning for every dollar of their own capital, they had borrowed 25 more. When the Russian government defaulted on its debt in 1998 and global credit markets froze, their models failed to account for the correlation of asset prices during a systemic crisis. They lost over $4 billion in under 4 months. The Federal Reserve had to orchestrate a $3.6 billion private bailout to prevent a broader financial collapse. Here's what Buffett said about this pattern. These people risked what they had and needed in order to get what they didn't need. That framing is essential. No level of mathematical sophistication protects you from leverage when the world does something your model didn't anticipate. Benjamin Graham, the man who taught Buffett to invest, introduced the concept of a margin of safety, the gap between what you pay for something and what it's actually worth. If an asset is worth $100 and you pay $70, you have a $30 margin of safety. If your estimate of value turns out to be wrong by 20%, you still break even. You've built protection against your own mistakes. The engineering analogy makes this concrete. A bridge that must support a 10,000-pound daily load is never built to hold exactly 10,000 pounds. A competent structural engineer builds it to hold 30,000 or 50,000 pounds. That extra capacity, the margin of safety, is not wasted. It's protection against aging materials, unexpected loads, and calculation errors. In practical terms, do not invest borrowed money in volatile assets. Keep an emergency fund equivalent to at least 6 months of expenses. Don't structure your financial life so precisely that one bad month triggers a cascade failure. The person who never goes broke is rarely the person who earns the most. It is the person who consistently avoids the catastrophic zeros. Rule 4. The gravity of your environment. Nicholas Christakis and James Fowler, researchers at Harvard and UC San Diego, published a landmark study in the New England Journal of Medicine in 2007 examining how behaviors spread through social networks. They found that obesity spreads through social networks like a contagion. If your close friend becomes obese, your own risk increases by 57%. Similar patterns were found for smoking, happiness, and financial habits. The mechanism is not peer pressure. It is something more subtle and more powerful. Your brain constantly recalibrates what is normal based on the behavior of the people around you. If the 5 people you spend the most time with complain about their income, make impulsive financial decisions, and treat debt as inevitable, your subconscious baseline for what is acceptable gradually shifts toward theirs. Buffett is remarkably direct about this when he talks about the partnership he formed with Charlie Munger. He did not partner with Munger because Munger would agree with him. He sought out Munger precisely because Munger would push back. Munger's intellectual standards and moral integrity consistently elevated the quality of Buffett's decisions over a 50-year partnership. Without that gravitational pull upward, Berkshire Hathaway would be a dramatically smaller company. Buffett has also described the most important financial decision most people will ever make as one that appears on no investment statement: who you choose to marry. This is not sentiment, it is a cold economic observation. A partner who shares your financial values, supports your long-term goals, and challenges you to maintain high standards is worth more over a lifetime than virtually any investment strategy. The uncomfortable assignment that comes with this principle: audit the 5 people you spend the most time with, not whether you like them or care about them, but whether they pull your standards up or drag them down. This is not about abandoning people who are struggling. It's about being intentional about who occupies the center of your orbit versus the periphery. And consider the inverse. Actively seek environments where you are the least capable person in the room. The psychological discomfort of being outperformed by the people around you is not a threat, it is a signal that you are in the right place to grow. Rule 5. Internal compounding. In 1952, a young Warren Buffett paid $100 to take a Dale Carnegie public speaking course. That $100 invested in Berkshire Hathaway the same year would be worth approximately $2.7 million today. But Buffett has said the Dale Carnegie course was the better investment because the ability to communicate clearly was the multiplier that made everything else possible. Think about what that actually means. He could analyze businesses better than anyone alive, but if he could not articulate his ideas clearly to partners, to boards, to shareholders, that analytical ability would have stayed locked inside his head. Communication is the interface between your internal value and the external world. If the interface is broken, the value never gets out. The research backs this up. A study from the Carnegie Institute of Technology found that 85% of financial success is attributable to skills in human engineering, communication, personality, negotiation, while only 15% comes from technical knowledge. That ratio is counterintuitive for high achievers who built their identity around technical excellence. The second component of internal compounding is the reading habit. Buffett is famous for reading 500 pages per day, primarily annual reports, business histories, and books on psychology and economics. Munger describes his mental model library as the key to Berkshire's unconventional decision-making. What makes this remarkable is the compounding nature of knowledge itself. A concept you learned 5 years ago doesn't disappear. It sits in your mental architecture, waiting to connect with something you learn today. The more frameworks you accumulate, the faster new information clicks into place. Munger calls this a latticework of mental models, and it's the reason that reading one book per week for 10 years produces qualitatively different results than reading 10 books in a single month. The final element, and the one most often overlooked, is the difference between intensity and consistency. The person who studies furiously for 3 weeks and then burns out contributes almost nothing to their long-term knowledge base. But reading 20 focused pages each day accumulates to roughly 20 books per year and 200 books per decade. That's the kind of intellectual depth that cannot be replicated by people who only pick up books when they feel motivated. The critical insight here is that this is the one asset that cannot be seized. Real estate can be taxed, currency can be inflated, a business can be disrupted by new technology, but the mental models, communication skills, and pattern recognition you develop over decades are permanently yours. They travel with you through every market cycle, every career transition, every economic environment. What Buffett actually measures. Berkshire Hathaway's market capitalization crossed $700 billion in 2023. Buffett's personal net worth exceeds $100 billion. By any conventional financial metric, he is among the most successful investors in human history. But here's what he talks about in his shareholder letters, in his university talks, in his interviews, more than any financial ratio or return metric. He talks about the people he's been surrounded by. He talks about his partnership with Munger. He talks about the integrity of the businesses he has owned. He talks about whether he's proud of the decisions he made. He uses what you might call a rocking chair test. At 90 years old, looking back at your life, you're not going to be reviewing quarterly earnings reports. You're going to be asking whether you treated people well, whether you built relationships you were proud of, whether the way you moved through the world was consistent with who you wanted to be. Money, as Buffett describes it, is a tool for freedom. It removes the stress of basic survival and expands your options, but it is not the scoreboard. The actual scoreboard is whether the people who know you best genuinely love and respect you, not because of what you own, but because of who you are. These 5 rules, radical selectivity, emotional detachment, margin of safety, environmental gravity, and internal compounding, are not just investment principles. They're a framework for building a life that compounds correctly across every dimension that actually matters. The engine matters, but the steering wheel determines where you end up.